Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Christopher Berrier, Manager of Brown Advisory US Smaller Companies, to talk about the opportunities for investors in the US small cap sector. Christopher, many thanks for joining us today.
Yeah, good day and pleasure to be here.
Great. So could you start us off by providing an overview of the Trust's objective?
Absolutely. So we occupy the small cap space. So the analogy I like to give sometimes is that we're climbing into a sandbox with a lot of different small cap companies. If you look over in one corner, you might have a bunch of misfits carrying on and you don't really want to travel over there. You look in the other corner and you see a bunch of people throwing sand at one another and you figure, I don't really want to go over there either. You look at another corner and you say, well, these people look like they're having a lot of fun, but there shouldn't be beer cans in the sandbox. And then you look over at the final corner and you say, reasonably well behaved, having a good time. Everybody's cooperating nicely. I think I'm going to go spend time in that corner of the sandbox. And that's effectively what we do. We go into the small cap space as long-term investors. We're trying to spend our time with companies that we think have the right ingredients, durable growth, sound governance, and can scale over time to be excellent long-term holdings on behalf of our clients. It is not that we don't spend some time in the other corners of the sandbox hoping that there might be a company or two that could wander over and become part of the corner that we typically occupy. It's just that generally we're spending all of our time looking for, across the landscape, high quality companies that can become good long-term investments. If we are reasonably successful at this endeavor of finding young companies that can become significantly larger over time, I think we will be able to produce reasonably good, call it double-digit-ish returns at a reasonable level of risk. And the way we manage risk is essentially at the portfolio level. One, we skew to quality. Two, we think about diversification a lot. And three, we are quite mindful of the valuations we pay for the businesses that we buy. So we're driving returns through bottom-up fundamental stock selection. There's no macro magic going on. And we attempt to protect ourselves to the downside or mitigate downside risk through the construction of the portfolio. So that's the fundamental aim. Our goal over a long period of time is to drive double-digit returns. And if we can do that at a reasonable level of risk, I think over a multi-year period, our clients will be happy at the end of the day.
Great, thanks for that. So one of the top contributors to performance in the last year has been ClearSecure. Could you talk us through the attributes that led you to invest in the company and also some of its key success drivers?
Sure. ClearSecure is a platform for authenticating identities. It resides in many of the airports, particularly the largest airports in the United States. And it's used to essentially move through the security lines at a much more rapid pace. They charge a reasonable fee of $100, $200 a year to become a member of Clear. And with that, you do a biometric screen that allows you, and then over time, if you add them, your family, to the dole, and you can pass through security lines at a rapid rate. We were drawn to the company because they have a monopolistic position in most of the airports. And if you think about the value of the service they provide to any frequent traveler, our view was that at the end of the day, they would have an ability to take their price up dramatically over time. Because I can tell you that as someone that's in an airport quite frequently, it really wouldn't matter to me if they charged $100, $200, $500, or $700. I would want to have that as an option. So it took a while for this stock to start moving. We had to be patient. We had to lean in a little bit here and there. But finally, what happened is people coalesced around the underlying understanding that the position that they have at the airports is reasonably secure. And while maybe their membership is not going to grow quite at the rapid rate it once did, the pricing power is there and you have a call option against them leveraging this platform elsewhere. They have it online. I won't get into the details there. And they have it at other venues, healthcare venues. They have it at stadiums and other places where you would want to move through a crowd more quickly, more effectively, and validating someone's ID. So it's an incredibly volatile stock. It's actually a bit of a controversial name. So our approach has always been, buy with a reasonable margin of safety. Think about what can go right, think about what can go wrong, and control your position size accordingly. So it was a good holding for us in the period that you referenced. It's still a small name in the portfolio presently, and we are monitoring their progress on the non-airport business quite intensely because we think that could be the larger call option that it has for future growth and profitability.
So one of BASC's key selling points is its focus on long-term risk-adjusted returns. What steps have you taken to manage downside risk for investors, given the challenging backdrop for small caps in the last few years?
I think that the small cap space has suffered over the last number of years due to the prolific growth in a handful of large technology companies. Those companies have, fundamentally sucked the oxygen out of the room. And most investors would rather own what they know and what is deemed to be great than gravitate down to the unknown and invest in something that could be great, but it's a little bit less uncertain. So it is this dynamic that's caused the relative performance of small over most years out of the last decade to be not so great on a relative basis. So when we look at companies, our first order of business is try to understand them fundamentally and qualitatively. We're looking at the building blocks of the business and asking ourselves, how stable are these? What's the probability that this company will be bigger and better in 3 to 5 years? And then how much do we have to pay based upon, a conservative long-term view? And that's where really the risk management starts. It starts with a basic understanding of the company and one that is actually pretty deep in nature. It then revolves around controlling the price you pay to basically limit the downside risk. And then as you get into the portfolio overall, you're looking at correlations. You're looking at fundamental business drivers. And you're asking yourself, do I have too many eggs in one specific basket? And do I not have enough in others? And if you keep asking yourself that question, what you will likely end up doing is creating a pretty diversified portfolio, again, that's anchored to quality and thoughtful valuation parameters, but is broadly diversified so you can build something that is reasonably all-weather in nature. If you anchor yourself too much to one specific area of the market, let's just say tech in early 2021, or you anchor yourself to, all biotechnology or something like that, the chances of you going through a period of really, really poor performance goes up dramatically. So while what we do is simple, we think over the long haul, it's commonsensical and quite effective. Anchor yourself to quality with a firm understanding of the businesses. Try not to overpay. Think about where the company could be in 3 years. Think about the upside relative to the downside. And then make sure you are thoughtfully commingling the businesses in the portfolio such that there are different attributes and different drivers that exist, because the only constant in investing is change. And the only thing we know about the future is it's unknowable and uncertain. So the benefit to diversification is one of the primary tools any investor has, whether it's an individual investor or a professional investor running an equity portfolio, to guard against future problems in your financial life. And so we spend a lot of time thinking about that. And we also spend a lot of time trying to better understand our companies every single day.
So changing tack slightly, there's been a noticeable shrinking of the small cap universe in the UK thanks to companies staying private for longer and M&A activity. Have you seen a similar trend in the US small cap sector?
Yeah, this is not going to be the most commercial answer as a small cap manager, but I'll try to give you a truthful one. The reality is that at the margin, the space probably has shrunk a bit. Not necessarily in the number of companies, but probably in the quality of companies. And so where that comes into play for us, and it's a realization in this incredibly volatile world that we have, is that if you're seeking out better businesses, you have to be incredibly fast and incredibly focused. And in fact, quite aggressive. We're conservatively aggressive people in order to get them into your portfolio at the right time and at the right price. And I think the evolution for the listeners is somewhat quite simple. So if you look at the small cap space, you've seen a lot of technology companies get very large in market cap quite quickly. So they're in the small cap universe for a brief, fleeting moment. They might be out within a year or 2 years. And they're replaced seemingly by less profitable or unprofitable companies in order to soak up the space within the Russell 2000 or some other popular benchmark. And so what that means is that the number of unprofitable companies has grown over time to the tune of, call it 30 to 50% if you're in the core or the growth area, up from probably 15 to 25% many years ago. And so I think while the universe in number of companies is still the same, I think the pool of higher quality businesses is probably smaller at the margin. And I think that there's a lot of capital chasing ideas, which means that as an investor, you have two duties. One, try to make sure you're not getting involved in businesses that are unsustainable, speculative in nature. And then the second one is to anchor yourself in quality businesses, which means you have to have a well-organized, appropriately deployed team. And you have to be conservative in the sense that you want to buy a good company at a fair price or better, but aggressive in the sense that when the time is right, you want to get involved, and you probably want to get involved bigger and faster than perhaps you would have felt necessary 10, 15, 20 years ago. So it's not a very precise answer to your question, but hopefully it provides a little bit of color about the evolution of the small cap space.
Thank you. Supermicro has become somewhat of a small cap poster child for AI. Do you see AI as a driver of potential returns in the Russell 2000 over the next few years, or do you think it's been overhyped?
If I had to place a dollar on overhyped or driver, I probably, in the shorter run, would place the dollar on overhype. I think in the longer run, I would probably place the dollar on a driver. The reason for that is AI is so new that no one really knows what the end state is. And I think that includes a lot of the companies that are at the forefront of the technology. What is the killer application that is going to justify $250 billion of CapEx spend against data center builds? What are the efficiency gains other than being able to craft an email perhaps a little bit more elegantly using AI, or have a chatbot that's able to carry on a chatting conversation with a prospective customer? Are there killer apps out there that are going to be massive revenue generators or massive cost savers in the future? There are dystopian views of that, and there are rather constructive views of that. I think when you look at small caps, the companies themselves that are benefiting in the here and now are largely rather mundane, older economy companies that do real stuff. This is not moving digital bits around largely. It's functionally building data centers, doing liquid cooling, HVAC, et cetera, et cetera, et cetera. And so I think what AI has done in the short run in the small cap space is it has made a cohort of relatively unsexy businesses for the last decade or so very, very sexy and much more valuable in the short run. The sustainability of this trend is directly attached to the level of CapEx spending by the hyperscale players such as Amazon, Google, Facebook, Microsoft, etc. And so I would tell you it is a driver. I would tell you Supermicro is a poster child. It's a rather defunct poster child that lost its auditor the other day and has sort of fallen from grace once leaving the benchmark. And I don't have a claim or a comment on the future of that business. But that is the fundamental question. When you look at it, are you riding super micros that peak and roll over? Or are you in things that can drive long-term, long-haul, sustainable gains? And I think that at the margin is what we're looking for. So nuclear, thematic, interesting. Industrial companies that are building infrastructure, including data centers or GLP-1 facilities, things like that. These long haul themes, if you can find the right company, and again, it doesn't get overhyped to the point where it has nowhere to go but down, I think can be drivers. I just think you have to be a little bit careful given that it is the thematic in the market. It is the driver of the market. And it is a well-known thing that everyone is involved in. And typically, that is a type of description that you want to be a little bit careful with, because if the trend doesn't continue, you have the potential to lose a decent amount of money relatively quickly. So AI, very complex topic, very exciting. I think a lot of our companies are clearly going to leverage it. A lot of our companies are using it. And I think that, it's something that has to be the forefront of every investor's mind, both positive and negative, as we move forward here the next couple of years.
So given the performance of US large caps over the last decade, and the Magnificent Seven in particular, why do you think investors should maintain an allocation to US small caps?
I think diversification is the only free lunch. I think that if you are all in on these larger companies, that one day they're not going to perform as well, and you would have wished you had diversified at some point in time. It is going to be impossible to figure out exactly when the overall momentum of the Mag 7 breaks and when sustained leadership within the small cap space is going to take hold. But what we do know is that it is, if you allow me a baseball analogy, we're probably in the later innings of the game in terms of large cap leadership. We have reached a point where both the concentration of the equity market and the concentration of the returns is quite significant and historic in nature. When you have a period like this, it eventually ends. And when it ends, capital goes elsewhere. It could go into treasuries, it could go into international stocks, it could go into value, it could go into small. But there is a settling out period when the prevailing trend ends. And then usually there is a shift in regime. New leadership takes place. That often, when you look at history, when there's an obsession with a small cohort of large cap companies, typically when that breaks, you do see a corresponding move in small caps over a period of years, where I won't comment on their absolute returns overall. Those could be astonishingly good or just fine, but the relative returns tend to be quite good. And so I think just as a diversification engine, one should have an allocation, and likely a permanent allocation, to small, where you lean in when the times are bad, and you probably lean away when everything is rosy and everyone loves small cap. So that would be my general advice. And I would tell you that just given a broad reading of history and stock prices and valuations and things like that, it feels like we are at a bit of an extreme in the large cap leadership. And therefore, if someone's massively over allocated to that area, it probably makes sense to put a few chips elsewhere on the table.
And one final question. How do you think rate cuts will impact your portfolio and also broader sentiment towards US small caps?
I think interest rates are almost the only game in town in terms of the directional move of the equity market, particularly the small cap market now. We have had a generation of investors that have essentially been trained not to fight the Fed. And that has led to people looking at the macro movements of the day and allocating to different exposures accordingly. So I think the interest rate question is a pivotal one. The interesting thing of late is that you've seen, yes, the shorter end of the curve go down with Fed cuts, but you've seen sort of out 5, out 10 years, you've actually seen rates be fairly resilient and in some cases rising. The 10-year yield went up as Donald Trump's odds of winning the election went up, and it went up even more when he won. So it's a very interesting climate overall, and it functionally could likely break either way. We are more of the view that the interest rate paradigm of old, meaning zero or negative, is likely gone because we have an inflationary environment that probably is more sticky than people would like. And whether you looked at the prospect of a President Harris or a President Trump, most of the policies that are being espoused are in and of themselves inflationary in nature, which probably means that while the macro may cause rates to go down a little bit, I think overall we're in a higher for longer phase, and they probably reached their historic evolutionary lows not that long ago. So the right way to think about rates in the small cap space is rates down benefits a lot of the long duration, sometimes the lower quality businesses, because all of their profits are way, way out to the future. So a small change in rates has a big move in a DCF valuation. And rates rising and inflation rising tends to be better for higher quality companies that have the ability to pass through pricing and things of that nature and manage their supply chain, et cetera, et cetera. So it can lead to very quick shifts in the leadership of the market. But our bet is slightly higher for slightly longer than maybe the consensus thought several months ago.
And on that note, many thanks for joining us today, Christopher.
Thank you very much for the questions. Thoughtful as always, and appreciate being here and everyone's time and attention today.
Thank you. And I'd encourage you to visit the Brown Advisory website to find out more information about the trust, including their latest insight articles. And you can also head over to the Kepler Trust Intelligence website, where you'll find more information on BASC, including our latest research note. Thanks for listening, and we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.